Hey traders, Raghi here. We're going to kick off this premium video with a look at some of the daily time frames that we've had our eye on for some longer term setups. Now longer term isn't necessarily that I hypothesize we'll be in this for days or weeks. That's a complete unknown. We're just getting in at one level and getting out at another. How much time lapses between that is an unknown, of course, unless there's a catalyst like non-farm payroll, like earnings, etc. So we do have non-farm payroll tomorrow. We'll keep that in mind for the early part of the day. So let's talk about gold. We sunk down into our range, and I'm looking for the market to go to the other side of the range. I say this is longer term because I will be in this overnight, and it's longer term because the time frame is a daily. The time frame is longer term. So the idea here is to take advantage of the movement back to the upside. Now, I'm looking for movement to about the 1765 to 1768 area. I'm treating this a whole lot more like this is a choppy market. My resistance is here, my support is here, and this is ranged bound chop, gang. It's a choppy market. So this is overbought, right? And this is oversold. And I'm just going to look for this market to keep going like this. Now, one of the things that I mentioned in the free video is that my bias is going to be respecting the trend that was, right? And the way we were moving was higher before we moved into chop. So I'd rather focus on the oversold buys. And if the market keeps moving higher, terrific. That's really what I'd like to see. But I want to at least take profit when I can, not when I have to, and then see if the market will keep going higher. In other words, I don't want to short this market. Speaking of shorts, let's head on over to the grains and talk about soybeans. So the first question is, Rog, are we long soybeans? No, I'm not long soybeans. This is not, for me, an uptrend. So think about what we just talked about in gold. I look at the trend that was. In this case, the trend that has preceded what we can call a chop and now a broken down trend was absolutely down. So if you look back, like what did the market do before we got here? It was moving down. Well, that means I'm going to favor what? In this case, not just trend following shorts, but overbought resistance and overbought shorts. So that means ultimately, yes, I could say to myself, well, the market moved beyond 861 and a half, and now it's actually at a V-score level. Now notice where our resistance is. So for those of you that are wondering, Rog, are we stopped out of the trade? No, actually, we've had a V-score zone in this area for a while. We're just going from the lower part of the zone, which was here, now to the upper part of the zone. This is all still a short, but what it's done is it's transitioned from what I would call a trend following short to now an overbought short, but it's still a short. Overall, what I'm looking at is this market to resume the trend that preceded where we are right now. Now, one thing we've talked about, and I want to reiterate again, is the minute we start looking at overnight positions, this is what I'll call a longer term setup because it's on a daily time frame. So clearly, I'm going to at least be trading this overnight. Now, a lot of traders don't want the exposure of quote unquote overnight. I mean, with the margin requirement higher, the uncertainty can be higher. This is not a truly liquid 24-hour market. The ZS is not like trading the S&P. Yeah. So a lot of folks, hey, you know what, Rog? I'm going to trade puts. So I'll buy or get long a put option here, and I'll buy or get long a put option there. And that's not uncommon to even the way that I like to trade. At the most conservative level, which would be the second or higher V-score resistance, you can see this resistance right here, I might actually short the underlying ZS, or I'll just trade a larger position of ZS. So let's say I got 25% of my position at the more aggro level. I'll go with, say, the other 75% at the more conservative level. Or maybe I grabbed the option at the more aggressive level, and I'll grab the underlying at the more conservative. Now, conservative and aggressive, or aggro as I say, has nothing to do with probabilities. It has everything to do with risk. You know, to say that something is a high probability trade versus a low probability trade, what that implies, and we talk about this a lot in the room, what that implies is I don't really like one part of the trade. right? I think it's more about aggressive and conservative, meaning how much am I risking? How much do I know? If I don't know that much about a market, there's a certain aggressiveness to it. And the aggressiveness means that, yeah, I'll take a smaller position size, but all the criteria is met. I don't want to take a trade where the criteria is not met, right? So I always want to look at high probability trades, but ideally, some of you might want to look at high probability plus lower risk. You can have high probability, higher risk. That would be the aggro entry, right? Okay, so let's talk about another market I know a lot of you are asking me about, and it's going to be very much in the same light of ZS. So just like soybeans broke through a certain resistance level, bonds have broken down through a support level. Am I a short seller of bonds? I am not. I can choose to get out of bonds. I can choose to exit my position because it's taken out some sort of percentage or dollar threshold. Absolutely. But all I've done now is look for a trend following long position in bonds to now an oversold position in bonds. And maybe that's going to be the lower part of the V-score. Maybe that's going to be the +1 reading on the V-score, which would actually be right here. Maybe I've got options and I've got the ability to sit through and take some heat. Maybe you'll say, you know what, Ron? I don't like that the trade has broken the validity. So let me show you something from the notes today, which I think will be really, really helpful. All right, so there are a handful of reasons that I would get out of a trade. So let me show you right here. Okay, so when I have options in a market, it doesn't matter if it's future stocks, ETFs. When I have options in a market, it doesn't matter. My, whatever this asset class is, my stop is usually 50% premium. Okay. I will also have a much shorter leash on options that are 21 to 30 days from expiration. That's time decay. Time decay starts to really accelerate. Remember, these are depreciating assets. The moment you buy an option, it's depreciating. The least important of the criteria for me to exit an options position is if the underlying is stopped out. It's certainly a reason, but it's the least important reason. So in this case, you can say, well, my option would no longer be valid because I've taken out the previous low, or I've taken out the value area low, right? Which is totally fine. But if I've got an option, then I want to use the fact that my risk is quantified to whatever I paid for the option. And as long as I've got time, as long as I'm not within 21 to 30 days, I'm okay giving this option a little latitude with the 50% threshold being my line in the sand. All right. So in this case, I do have some TLT calls. I have some ZB and I have some ZB calls. The ZB futures would be smart to let go. The calls, I might give myself a little bit of latitude. So that's how I use options to sort of let me deal with sort of these kinds of volatility moves, whether that be the one in beans to the upside through resistance or the one here in bonds to the downside through support. These are all things to keep in mind. So the next thing we want to look at here is corn. Corn is actually holding its own within the range pretty darn well. Now, one thing that you're going to want to remember, so a lot of folks don't like trading these grains and meats and so forth because you are subjected to sort of the non-farm payroll-esque type reality of the fact that there are different events that affect the futures of cattle, grains, softs. They have their own inventory numbers. They have their own, in the case of grains, planting and harvesting and USDA crop reports. The USDA crop report is like what non-farm payroll is to the indices. USDA crop reports can be to corn, wheat, oats, soybean meal, soybean oil, right? So keep that in mind. And that's a whole other set of dates and releases to be aware of. And we'll talk about that in a future premium video. All right. So then moving on to our day trades today. Actually, the day trades today were awesome. I did a recap that I sent out as an alert. So do check that out when you have time. And what we did today was we got long the Russell and the Dow. So just a few things to say about the way that I like to day trade. Most of my day trading is going to be concentrated to the morning. I don't like trading the second half of the day. I don't like trading into the close. I think the percentages, your probabilities, if you want to go back to that, I think probabilities for follow through can be much trickier in the second half of the day. That's just based on what I like to see. Different traders, different tools, different approaches. They might like the second half of the day better. But for me, and you guys have watched me all this week, we put 4 trades on Tuesday. We went 2 for 4. I like to think of myself as a batter. How did you do in the game? I was at bat 4 times, 2 out of 4, right? I got on base. On Wednesday, we went 2 for 2. Today, Thursday, we went 2 for 3. That's a fantastic week as far as I'm concerned, right? So in terms of today, and in terms of when I shut it on and off, next Thursday, we're going to have a earlier session where I'll start around 8:15, and I'll walk y'all through what I like to do with things like initial claims in the S&P and the Dow. In fact, I might be looking for something similar in the non-farm payroll tomorrow. So keep an eye out for that. Around 8:30, if you see me either in the room or sending out an alert, I'm going to be looking at what I call the first come, first serve fade. We did that in crude oil just yesterday. Here, initial claims today. Check out the videos. You'll see it's the exact same trade. Let the event happen. Let the reaction move the market to one end or the other of our range, in this case an HPMR range. First come, first serve. We sink down into support. That's a buy. Okay? So you guys are just kind of getting your sea legs with this particular setup. I mean, we've done this now about 4 or 5 times, mostly focused on the EIA crop report, or EIA crude oil inventory number. And yesterday it was good for a 70-cent rally, which was great. Today it was good for another nice rally off the about the 30.96, 30.97 area, easily into as we move higher here, about 31.10, 31.11. So these are the things that I will call first come, first serve, that require a high impact or a high volatility economic event to sort of trigger these extreme reactions. And it's those extreme reactions that drive us to one end or the other of our range. Of course, the range can be defined by the V-score, but you'll notice I tend to like using my hourly price movement range calculation to project, based on historical volatility, where that sort of turning point or that exhaustion might be. Okay, so heads up, I might be looking at that tomorrow for non-farm, but we'll definitely do that together next Thursday in the chat room for our initial claims. And of course, we'll do it as we have for the past month or so in EIA next Wednesday. So check those videos out. That's tonight's premium video. All right. Oh, you know what? Let me mention one other thing. Do check out that supplemental video that I sent out via the alert. But you'll notice that the NASDAQ did not give us a clearing range breach. And let that be a really good heads up. Let that be sort of a really good warning to us. I still traded the NAS, and I'll go 2 for 3 any day of the week and be happy about that. But I could have easily decided not to take this trade, which in hindsight would have been a really good call. Why though? It's got to be very process driven. 15-minute breach, yes, but we never had that 30-minute clearing range breach. And one thing you can do is, if the early breaches are not followed up by a 30-minute breach, a clearing range breach, if you still have unfilled, untriggered entry orders, by 10:30, you can choose to cancel them. Because that clearing range, that tip of the hand, if you will, the market sort of tipping its hand directionally, that's a big one. And you'll see what's happened when we didn't get the clearing range. Not that that scale of the sell-off is indicative of not getting a clearing range, but the exhaustion is. Okay? So think about that. Check out the video that I pushed through in the chat. It should be sitting in on your app. Check it out, and I'll see you in the next update.